This is Randy Martinson with Progressive Ag Marketing out of Fargo, North Dakota. And today, USDA came out with their supply and demand numbers for the October report, and it came out to be a little bit more bearish than what was anticipated. When you look at the numbers, USDA came in and increased corn production quite a bit by raising the yield up to a 164 level. A lot of that was somewhat expected by the trade, probably not the 164, but we were looking for an increase in corn yields. Soybean yields were not increased as much, so this report wasn't as bearish to the soybeans as what we were looking at for corn. Right now, the numbers that we're looking at, ending stocks did increase quite a bit for corn. And we're looking at a 1.6 billion bushel crop, as to soybeans 230 million bushels. So we are looking at increases in the ending stocks estimate. Now, one thing that we can look at for this report is we are looking at the crops getting bigger, which was anticipated, but we are looking at the corn getting a little bit bigger and faster than what the soybean crop has been doing. What producers should be looking at doing with this report now is evaluating where their corn crop's going to come in. We've been a proponent of putting corn in the bin, using the carry to and sell against that. This is probably a good time to be looking at selling more of this carry in the corn market. One thing I would look at is looking at putting some hedges against the March, the July, and even the December 10 contract, as they are holding the best premium, and there is a full carry to be able to sell into this. Soybeans, what we've been kind of telling producers is to sell off the combine, or at least try to get as much of that product sold as we can. The big thing we're looking at there is that basis levels are tight. We continue to see no carry in that market. And with soybeans, we are looking at the pipeline virtually being empty, and the end users are coming out and wanting to get that product brought into town. We are still seeing good basis levels for corn as well, so now is also a time frame if you need to move corn off of a combine because of storage constraints. It's probably not a bad time to move that corn and try to hold on to as much as you can in the bin. Now, with these end users coming in and needing the soybeans, it does give us an opportunity to move the soybean crop and look at buying it after we see this market bottom out. I would look at trying to re-own soybeans once we hit that 880 low that we've experienced, which we don't think we can go much below that at this point. And again, we're going to be looking at the 330 level as support for corn. The big thing to look at as far as the other crops is in this report, wheat numbers were increased dramatically, and we still look for that to be increased in the November numbers. So wheat is going to be kind of the bearish tone of all the markets, and one that we don't really look to be able to sustain itself. USDA is going to come with new numbers in the November report as well, and that's going to continue to be bearish. And with that taking wheat down, corn's going to have a little bit of a competition run there as far as in the feed ration, as we will get wheat cheap enough to start entering the feed rations at that point. So we'll have wheat pulling corn down a little bit, but corn is probably going to be the market that will have the best as far as this report goes. Soybeans will also have not as much pressure. We're looking for the market to be down about 10 cents today, mainly because of the report and also because of just profit taking after this week.